Welcome to Debt Matters.
Today, we're looking at some pretty stock figures from the Bank of England. They're from late 2025, tracking consumer credit for November.
And they really do paint a picture of accelerating borrowing in the UK. So for anyone in risk or collections, this is, well, it's a bit of a warning light for the new year.
It is, and that's our goal today, really, to help you unpack what this acceleration in borrowing truly means for your strategy, for what you should be doing as we head into Q1 2026.
Right. We want to go beyond the numbers and get to the actionable insights. What does this mean for the people on the front line?
We should probably just state the core finding right away, because it's the headline that really matters. Net consumer credit borrowing rose to £2.1 billion in November.
Which is a big jump.
It's a huge jump. It's up from $1.7 billion just the month before, in October. That's a $400 million increase.
And it's that speed, that velocity that we need to get a handle on.
Exactly.
Okay, so let's start there. Let's unpack this surge and also look at a strange paradox around cash that's happening at the same time.
So if you dig into that £2.1 billion figure, you see one thing driving it more than anything else.
Credit cards.
Credit cards. It's the highest cost, most immediate form of lending, and it's where the action is.
The numbers are pretty clear. Net borrowing on credit cards alone was $1.0 billion in November.
Which was up from, what, $0.7 billion in October?
Yeah. So in just 1 month, a 43% increase in net credit card use. That tells you where the immediate pressure points are building.
And that monthly spike feeds directly into the annual growth rate. It's now up to 12.1% for credit card borrowing.
Up from 10.9% the month before.
And that 12.1%, that's the fastest rate we've seen since January 2024. So we're seeing pressure that hasn't been around for almost 2 years.
That number, 12.1%, that should be the first item on the agenda for anyone modeling Q1 arrears. It just means a massive expansion of the riskiest part of the loan book.
And even if we zoom out a bit to, overall consumer credit, so personal loans and other things, that annual growth is also up. It's at 8.1% from 7.5%.
So the whole system is heating up, but it's really the high-cost revolving credit that's leading the charge.
Yeah, without a doubt.
So why? What's driving this? The reporting points to two big factors coming together.
It's a confluence of two things. First, you have the predictable seasonal pressure. It's November. People are spending for the festive season.
Lenders always plan for that.
Of course.
So.
But the second factor is the one we need to watch. The ongoing, just relentless cost of living strain on household finances.
And that's where the risk really multiplies, isn't it? When you layer that seasonal spending on top of a baseline where people were already struggling.
Exactly. If the economy were stable, you'd see a spike and then a quick pay down in the new year. People treat it like a short-term loan for gifts.
But that's not what's happening. You're layering it onto households that were already using credit to bridge gaps for, rent, food, energy.
And their ability to bounce back from that Christmas spending is it's severely diminished. You might be pushing a vulnerable customer past a point of no return.
So collections teams need to see this differently. It's not just overspending.
It's a structural problem. It's a symptom of a deep cash shortfall. And that requires a completely different collection strategy.
Now, here's where the data gets a bit strange, because it's not a simple story of everyone running out of money.
Right. This is the savings and borrowing anomaly. It's a really important wrinkle.
So while people were adding £1 billion to their credit cards,
they were also collectively adding a massive $8.1 billion in deposits, in savings.
8 times as much saved as was borrowed on high-cost plastic. It seems completely irrational. Why borrow at, say, 20% while you have cash sitting there earning maybe 4%?
Because it's a form of very expensive self-insurance. It signals profound economic uncertainty.
So people are stockpiling cash?
They're building a defensive buffer. They're holding on to that cash because they fear a much bigger shock is coming, a job loss, a mortgage rate hike, something catastrophic.
And they're using the credit card as the bridge for this month's essentials to avoid touching that emergency fund.
That's the key insight. They're choosing security over financial efficiency. And for risk teams, that means some of these customers might look fine on paper. They have money in the bank.
But their behavior, the high utilization, the volatility, that tells the real story of hidden stress.
Which brings us to the operational side of things. What does all this mean for arrears risk in Q1 2026?
Okay, so if we saw that 12.1% growth rate in November, what does that mean for collections volume in January, February, March?
Well, the most immediate consequence is a rise in early arrears. It's a direct relationship.
More revolving credit use means more accounts tipping into one or two missed payments right after Christmas. The bills land in January, and they just can't make that minimum payment.
And that early stage, the first 30 to 60 days past due, is absolutely critical. That's where you win or lose the battle for cure rates.
The cost of letting an account roll forward is huge.
It's exponential. Engaging early costs pennies. A text message, a full default, costs a fortune in staff time, write-offs, legal fees. You get 3 to 4 times the cure rate by engaging in that first 30 days.
So operations need to be ready, not just for more volume, but for smarter, earlier engagement.
Exactly. And the nature of that engagement has to change because the debt itself has changed. This is about shifting affordability stress.
We've established it's often for essentials, not luxuries. It's structural.
So the old collections approach of you've mismanaged your budget, you need to pay in full, is just going to fail.
And that failure means two things, right?
Two very damaging things. First, higher rates of redefault. The customer agrees to a plan they can't afford, and they fail again. And second, much higher complaint risk because they feel you aren't listening to their reality.
And all of this is accelerated by the high interest rates,
The high rate debt trap, yeah. We know card rates are hovering in the low 20s.
which is just corrosive on a balance that's not being paid down.
It creates that spiral. Let's say you've got a £3,000 balance at 22%. Your monthly interest is about £55 if your minimum payment is £60.
Only £5 is actually touching the principal debt.
Barely. The balance never really goes down. This is why you have to intervene early, before the interest compounds to an unmanageable level.
And it's why old risk models just don't cut it anymore.
They don't. That paradox of saving and borrowing is the clear signal that just looking at someone's salary isn't enough. You need to model the behavior.
So what are the key factors to look at in Q1?
I'd say 3 things. Utilization, velocity, and volatility. Utilization isn't just the raw number, it's the ratio of debt to available credit. 90% utilization on a small limit is a huge red flag.
And velocity.
The speed of change. A jump from 10% to 80% utilization in a couple of months suggests a sudden shock. That's a higher risk than someone who's been sat at 50% for years.
Okay, that makes sense.
Yeah.
So this takes us from diagnosis to action. What are the key strategic moves for collections teams right now?
First thing, you can't wait for the arrears to hit. You need to tighten your pre-arrears triggers.
So acting before the payment is even officially missed?
Yes. Look for those behaviors we just talked about. A big spike in utilization. Suddenly using multiple credit cards. Payment reversals are a massive one.
A reversal means they tried to pay but couldn't.
Exactly. That should trigger a sympathetic outreach call, not a penalty. The goal is to intervene at day 0, or even day -5.
And once that trigger is hit, the next step has to be frictionless.
Optimize that first 7 days journey. That's the window when the customer is most receptive to a simple solution.
And friction reduction means what in practice?
It means one click from a text message to a payment plan page. It means clear options. And, crucially, it means prioritizing self-serve.
Because people feel embarrassed.
Immense embarrassment. They don't want to call and explain their situation. Letting them set up a plan online removes that emotional barrier and boosts cure rates.
And we know not all this debt is the same. Some is seasonal, some is structural.
So you have to refine your segmentation. Refresh the models to treat seasonal spend differently from structural shortfall. A seasonal spender might just need a gentle nudge. A structural shortfall customer needs a long-term sustainable plan and probably a vulnerability assessment immediately.
Which means you need more flexible plans to offer them.
You have to expand your repayment plan design. Offer smaller first payments to get them started. Align pay dates with their income cycles.
And you mentioned step-up plans. How do they work?
They are powerful. You start with a very low payment for, say, the first 3 months. This gets the customer engaged and builds trust. Then the payment gradually steps up to a higher, more sustainable level once they've stabilized.
As long as it's all transparent.
Transparency is everything. They have to know when and by how much it will increase. But it's a great tool for improving long-term success.
And beyond the mechanics, there's the human element, the tone.
Non-negotiable. You have to signpost vulnerability support everywhere right up front. Train agents to spot distress language. Empathy is now an efficiency tool because it improves engagement.
Okay, last point. Getting ahead of complaints.
You need to do a proactive complaint review now. With volumes rising, any weak spots in your processes, especially around fees and interest explanations, will surface very quickly. Fix the clarity of your letters and scripts before the wave hits.
So to pull this all together, we have credit card growth hitting 12.1%, driven by this mix of festive spend and real cost of living strain. We see this anxious behavior of saving and borrowing at the same time.
And the overarching message from that is clear. The 12.1% growth rate is your operational cue. More customers will need help, and they'll need it earlier. The focus has to shift from recovery to sustainability.
So as you plan for the next quarter, here's a final thought to take to your team. We've seen that a customer is willing to pay that high credit card APR just to protect their cash buffer. So how might focusing on the volatility of their financial decisions, the swings in their balances and utilization, reveal more about their true default risk than just a static number like their income?
If you can model that behavioral anxiety, you can get ahead of the risk before the first payment is even missed.